Strategic asset allocation, SAA, is the long-term process of determining how investment capital is distributed across asset classes to achieve specific risk and return objectives. Traditionally, strategic asset allocation has focused on factors such as expected returns, volatility, correlations, liquidity requirements, and investment horizons. However, ESG factors are increasingly recognized as financially material considerations that can influence long-term economic growth, market performance, and investment risk. As a result, investors are incorporating ESG analysis into strategic asset allocation decisions to improve portfolio resilience, identify emerging opportunities, and better manage sustainability-related risks that may affect long-term investment outcomes. ESG considerations have therefore become an important component of modern portfolio construction frameworks. One way ESG factors affect strategic asset allocation is through their influence on long-term macroeconomic and market trends. Issues such as climate change, demographic shifts, technological innovation, resource scarcity, social inequality, and governance quality can shape economic development and investment performance over extended periods. For example, climate-related transition policies may affect the future profitability of carbon-intensive industries, while aging populations may influence healthcare and retirement-related investment opportunities. Investors increasingly assess these structural trends when determining long-term portfolio exposures because ESG megatrends can alter expected returns, risk characteristics, and growth prospects across regions, sectors, and asset classes. ESG factors also influence strategic asset allocation through their impact on risk assessment and portfolio resilience. Environmental risks such as climate change, biodiversity loss, and resource depletion may affect economic stability and asset values. Social risks related to labor markets, demographic changes, public health, and inequality can influence consumption patterns and economic growth. Governance factors such as regulatory quality, institutional effectiveness, and political stability affect investor confidence and market functioning. By incorporating ESG considerations into strategic asset allocation, investors seek to better understand long-term systemic risks and improve portfolio resilience against sustainability-related challenges that may emerge over time. At the asset class level, ESG analysis can influence allocation decisions among equities, fixed income, real assets, infrastructure, and alternative investments. Investors may increase allocations to asset classes expected to benefit from sustainability trends, such as renewable energy infrastructure, green bonds, sustainable real estate, or environmental technology investments. Conversely, they may reduce exposure to areas facing elevated ESG-related risks. Sovereign debt allocations may be influenced by governance quality, environmental vulnerability, and social development indicators, while corporate asset allocations may reflect sector-specific ESG opportunities and risks. Strategic asset allocation therefore increasingly incorporates sustainability considerations alongside traditional risk-return objectives. Many institutional investors, pension funds, endowments, insurance companies, and sovereign wealth funds integrate ESG considerations into strategic asset allocation to fulfill fiduciary responsibilities and support long-term investment objectives. ESG integration may involve climate scenario analysis, sustainability-themed allocations, exclusion policies, stewardship objectives, or assessments of systemic ESG risks. Some investors also incorporate ESG beliefs into capital market assumptions used for strategic planning. By recognizing that sustainability factors can influence long-term economic and financial outcomes, investors aim to improve portfolio performance while aligning investments with broader environmental and social objectives. This approach reflects the growing recognition that ESG issues are relevant to long-term wealth preservation and value creation. Ultimately, ESG factors affect strategic asset allocation by expanding the traditional investment framework beyond purely financial variables. ESG analysis helps investors identify structural changes, assess long-term risks, evaluate emerging opportunities, and understand how sustainability issues may influence future investment returns. Effective integration does not replace traditional asset allocation principles but enhances them by incorporating additional sources of information relevant to long-term decision-making. As sustainability considerations become increasingly important to economic development and financial markets, ESG-informed strategic asset allocation is expected to play a growing role in portfolio construction. This approach supports more comprehensive risk management, improved resilience, and sustainable long-term investment outcomes.